Hey guys, I hope everyone's been doing really well. I wanted to go over a little bit about why we thought the market would go to 450 from our market review before CPI. And I know a lot of people might have been bearish or thought, okay, this economy's slowing down, the market's not going to go up. Something to realize compared to last quarter is we are basically at last quarter's prices, right? And CPI, because they're saying, hey, we're not going to raise rates anymore, is also implying we can also possibly go into deflationary territory where now the interest rates start going down into the next forward coming FOMC. Even if it stays flat and then goes down later is okay because we are going again into a strong earnings quarter. This is exactly what happened to last year. So last year in October, going into November, December, January, the market started rallying, starting first with BA in September, then NVIDIA in October, followed by Google, Meta, Amazon in November. December was Tesla, MSTR, and then lastly was January, Apple, Microsoft. This year, it's going in a little bit different direction where Apple was able to skyrocket, and they always have a very strong quarter at the end of the year. 4 quarters out of a year, 3 of them are mediocre, and 1 of them is amazing. They're way higher revenue than normal quarters. So as long as they're saying, hey, no more rate hikes, the mega caps that are most affected as far as future assets, because everything trades on a 10-year forward PE basis, then what happens? All the mega caps have a chance to rally back above last quarter's high. All these companies, despite the rate hikes, are making more money. So guys, this is a great time to go long, and I hope everybody is staying green. Maybe, we're able to capture some of the swings that I've been posting for the past month, and that we're all making money, right? Keep yourself educated on CPI, FOMC, PPI, the bond market, interest rates, and inflation, as well as earnings and how they all play out on price action for the S&P 500. So here's a quick recap of what we thought, where we shared with our community during our market review last week.
Okay, so this week we're going to do S&P 500 review, interest rates, FOMC, what happened last week, what will happen this week. This week I took out all the moving averages just to make the chart clean, because technically we could theoretically, using only technical analysis, we should be able to determine what is happening in the market. Just so everyone knows, just backtrack until 2000, about 2000, even back to 2003, even the chances of getting 4 red months in a row are highly unlikely, right? There's little times where, like here in 2011, there was 4 red months in a row, right? 5. Even during the pandemic, there was only 3. Okay, so, and then even here, there's only 3 here. And then here in 2007, there's 3. There's 4. So for the last 15 years, that only happened twice, where the market was 4 red months in a row. Okay, so that tells us it's very unlikely that November is going to go red, right? Very unlikely that it will do that. So November is most likely going to end up bullish, and it's only in the middle of the month. And this candle is already really bullish. It's reversed. Okay, so it's reversed from that 420 level. So let's put that level in. Okay, so 420, that's a good level that needs to hold. We closed up at 440 already. I think the next level up from here, and we could break into this level, would be if we break 450, we get to 460. And I don't think there's a coincidence, or perhaps there is it's 420, 440, 460, and then the top is 480. We're moving in increments of 20, at least on the monthly chart, at least to me. Okay, so the SPY is very bullish here, and the fundamentals support it. So the strength of the economy supports this, and inflation is going down. The unit labor cost, like the cost per unit of labor, is going down, and so the monthly chart is bullish. Okay, now we're going to go to the weekly. Okay, so here's the weekly chart, but here we reversed 2 weeks ago off that 410 level, right? Broke through 420, which is key. Broke through this little resistance here at 437. We cleared it last week too. So that's strong on this up move. The only thing we can now say is the range of these candles is getting narrow. So what am I mean by that? Right? This is a big long candle. We reversed big time. This means a lot of buyers jumped in, shorts covered, creating this massive momentum up. Definitely, there's huge buyers in this area now. So the market is now defending. I would say 420. Huge defending here. Market is broke out, defended here. Now, huge buyers are stepping in here. This chart is extremely bullish on the weekly as well. This big reversal and even this consolidation here. Now we just have to break through this wall here, which is, I'll say 440, 450. So I think that's the next battleground for this week and even next week, right? Because if we break 450, it's going to be quick to get to 460, in my opinion. Why do we say that from technical analysis? Because this level up here has been tested 3 times, 1, 2, and 3. If we do test 4, 6, if we do break into this level, the amount of selling pressure is going to be less. Okay, that's something that you have to understand about technical analysis. There's a million sellers here, and then some people got sold here. Now there's 800,000 sellers here. Now it hit here. Now there's only 500,000 sellers. So up here, the number of sellers is actually dropping. Okay, it's just something intuitively you have to know by the rules. Okay, it's not like they added more selling pressure. It's like it's decreasing. Okay, so up here, this is really bullish on the weekly chart as well. Okay, so daily Tuesday is CPI. Wednesday is PPI. All right. Okay, so is the daily chart bullish here? Yes, right? It's gone it broke out and then it consolidated here. It consolidated in this area, right? Underneath this underneath here, and it broke out on news and on volume. Like this volume confirms it. Look at this huge candle. So yeah, even on the daily chart, this is if I'm just looking at the chart and saying, hey, the chart suggests there's a lot of strength here. Maybe it's some consolidation, but it looks like it wants to break this trend here, break this trend line. It's very strong. Okay, so here I'm going to take the opportunity to add in the moving averages. So moving average number 1, let's just add it one by one. 20, the 20-day simple moving average. That's the short term, right? Apply. So we're above that. We're way above that. So that's at 427 support. Okay, that's good. That's good to know that we're way above it. Okay, and then now we're going to do the 200. Actually, we'll do the 50. That's the midterm. Okay. So look, the 50 is at 432. The 50 is at 432. That's awesome because the market held above it all last week, creating a massive support level at this level. So, and now we're just trading above it. So that's extremely, like we're above the 50, above the 20, and we've consolidated. That's really bullish. The market is saying, hey, look, we're dipping, but all these dips are being bought, right? That's strong. Okay. And the last thing is just, let's put in the 200, which is the long-term trend of the market. Okay. So we're actually sitting above all the moving averages. Really strong move. On October 7th, when Hamas attacks Israel, the market pulled back. The market pulled back, right? That was this. See here. That was here. October 7th. So in this area, that all of a sudden started pulling back, right? Okay, so we're even on the here. I'm just bullish. So just looking at the technical analysis, for the record, I'm bullish based on the analysis on the technicals alone. We're not looking at fundamentals or FOMC or economic data or anything. Just purely on the fundamentals alone, I expect us to continue, possibly consolidate, but more often than not, we're continuing higher. So PPI must be both good for the market, and it looks like for me the range could easily be above 445 and even 450 by end of the week. That's my target for this week, 450 minimum. Okay, so I'll leave it at that, and Esther can do her analysis as well on.
If CPI projects that we're not going to be raising rates for sure now, right? Then it's going to let the market continue to climb up. So this is normal bull market, SPY, Tesla, Nvidia, QQQ, Apple, Microsoft on the top with Berkshire Hathaway, right? This is like what happened on Friday. So after this outflow in, out, in, out, in, right? This is on 1 year. So look, there's capital inflow. There's like markets going up. It usually goes up then down, obviously. But the last time, it barely went up a little bit, and then Hamas happened, right? and then it had to like recover. And then this is just on a 20-day. Now it's overall more buyers than sellers. So there's not that much fear in the market, right? We saw the VIX going really low this week, but it looks like they want to make it go up. But at least overall, higher strikes. And then again, more calls. And then more calls, right? Again, higher strikes. 435 seems to be pretty sticky to the 440, 436, 446, right? We see some puts at these upper ranges, 440s. So this could also reflect like the price action they're seeing on CPI. It doesn't mean you have to trade 0 days. You can trade into Friday, but the wider range for this whole week is it's 7 points, 650. It's actually not that big. What was your target again?
450. It's a little bit aggressive, but
Okay, so the breaking point of calls to puts here on Friday is 440 to 450. So somewhere in between this range is where they wanted to close into the end of the week.
because we know that within 6 months, the FOMC, the Feds are looking to cut the interest rates, right? Because we know from this probability here, like May, there's a 50% chance in May that they'll be cutting their rates for the first time, right? Because they're holding the rates 85%. 85% they're holding the rates in December the same, and then in January, and then in March, and then in May, 50% chance they're going to be cutting, and it goes down from there. So just think about it. Within 6 months, if the interest rates are dropping, that will stimulate the economy, right? The economy will be stimulated again. The economy will, right? The cost of borrowing for people will be less. So the debt service will be less. So there will be more cash in the bank account for each household on average. So that's going to stimulate the S&P 500. So that's within 6 months. So if you're a bank, an institution, or an investor, and you call up your bank and say, "Hey, look, I have $1 million to invest now because now should I put in the money?" The bank's most likely going to say, "Yeah, now's the time to buy," because they're not trying to get the exact bottom of the SPY, right? They're not waiting for. And I bet you when it was here, they bought as much as they can because within the 6 months it's gonna go up. So I still think there's still a lot of money left to be bought. So this move continues up, I think. Even almost like even if the data is bad, they'll still be buying, in my opinion, because they just realize that they'll be cutting rates. I just want to show you here, right here, that its forecast is coming at 3.3. Okay, so it's less. Its forecast is coming less. So if the actual comes in just a little bit higher, 3.4, or even less at 3.2, either way, the inflation trend is coming down. Like it was at 3.7, it's coming down, right? So that's what the Feds want. The Feds want inflation to come down. So that's bullish for the market. That's good. Okay, so that's good. I'm expecting Tuesday to be good. Okay, PPI is the same. PPI is roughly the same since the forecasting is 0.1. Okay, the previous is 0.5. They're forecasting PPI to come down too, because we know this too from the unit labor cost. The cost of labor is actually dropping. So that's good too. So both of these should push the SPY above 445 is what I'm thinking. The Fed speakers are, some think that we're at a good spot. We just have to wait until the interest rates impact the household. That means right? And then people realize that, hey, their debt, they can't pay off their debt. Now the market goes into a little mild recession. Okay, so it's just a mild one. As soon as the market goes into a recession, then the Fed will say, hey, this is good. Market goes into recession. People are not buying anymore. Now we can cut their rates and people could start buying again. So the Feds are in a good spot, I think. Okay, and you can see that from the technical analysis. It's just ripping straight up from here. See, like it's nonstop. And even on Friday, the news was bad, but the market went up on that news. The market is just thinking it doesn't matter now.
Can you go over, Michael, is this was the Moody's downgrade?
Okay, yeah, I'm gonna go over that right now. So there's three institutions in the United States, right? There's three institutions. There's Moody's, there's Finch, right? Remember Finch downgraded the government too. Finch, that was like a month ago. Moody's, which is S&P 500. S&P stands for Standard and Standard Poor's, right? So so Moody's have downgraded U.S. credit. That means that U.S. credit means the Treasury, the bonds. Okay, the bonds. You know how the U.S. government has to raise money by issuing bonds to the countries, to the investors, and through normal people, right? And when we buy the bonds, or when the banks buy the bonds, or when the China buys bonds from the United States government, the United States government pays them back, pays them in interest. That's how the United States borrows money. Okay, so now Moody's is saying, wait a minute, when the United States borrows money, there's going to be a problem paying it back, right? So they got downgraded from stable here. See that? Oh yeah, okay. Stable to negative. Don't get me wrong. There's still a very good. They talk about here Finch this year too. So they talk about that. Okay, so Finch and here stable. So basically, I think this impact will be noise only. That's the key. Tomorrow there'll be maybe slight red only on this news, but overall, the institutions are going, and including me, they were just going to bypass this because we know the United States government bonds are as good as gold, basically. Like, there's never been a time where there might be, I don't know, maybe in the 1900s where they couldn't pay it back, but in modern history, there's never been a time where the United States government has defaulted on paying back bonds. 30 minutes, market's down a little bit, but I think market continues up. So some raising concerns, some issues about the economy. And we already know that the economy is supposed to be slowing down, right? The economy is supposed to be slowing down because that's what the Feds want. So it's actually confirming what the Feds want. So you could even spin this and say this is actually good that we know this. Okay, I think we're gonna try to do a massive rally, right? We get to 460 quickly, and in December we're gonna spend most of December trying to get from 460 to 480. That's what I think is gonna happen, right? That's what So that's what I think. So that's why I'm a bit aggressive for 450 here. Okay, so that's the fundamentals of the market right now.
So if Moody's downgrades that, then that's almost reiterating or confirming what the Feds want, meaning next time Powell comes out, then the sentiment of rate hikes now going into deflationary rate decreases is more probable, right? Is that
It's
why?
more probable.
Right.
This is Jay Powell speaking on Thursday. Okay, so wait, let's just put the time in. So 1 o'clock, there was the auction. So right here, the market right here on this big candle. So the auction. So how does the auction work? The Feds, right, or the Treasury, the U.S. Treasury, they need to borrow money. The only way to borrow money is by issuing these bonds. There's a 30-year bond that they're issuing. So whoever buys these have to hold these bonds for 30 years to get the interest payment. Okay, you have to hold it for 30 years. So this crashed because nobody wanted to buy it. The interest rate came out at 4.5%. If you hold it for 30 years, you get 4.5%. You get 5%. So nobody bought it. Nobody said, no, we're not buying this. We're not doing this. So they had to raise the interest rate to 4.7. So when they raise the interest rates, the market's saying, wait a minute, there's a couple reasons why nobody bought it there. They want more interest. The 30 years too long. They think there's going to be an economic recession. Why hold it for 30 years, right? So the market tanked. Market pulled back really quick. Like, market reacted negatively to that. The market wants buyers for bonds, U.S. bonds, right? China holds, like, I don't even know now. There was trillions of dollars. In Japan, I think, now holds the most number of U.S. treasuries, right?
But Japan kind of stopped buying U.S. treasuries and started putting more money into their own economy.
Yeah.
So a lot of those bonds
familiar,
are being bought by like foreign countries, especially Japan. Japan used to be like the biggest holder of bonds, U.S. bonds. It's like if they're like retracting back from that, then yeah, nobody's buying them anymore.
Okay, and then at 2 o'clock here, this is interesting for you guys to know too. So that's why I'm reviewing it for really quick. 2 o'clock, and we typically have this in daily ranges. Most of the time, 99% of the time, I'm gonna say 99% of the time, I know what will happen in the market. All the news points. Like, honestly, I don't know the reaction, like if it's going to go up or down, but I know at 1 o'clock, guys, we got to pay attention. This is the time where it's going to move, right? We're not going to do anything here because the market's not going to move. Okay, so like 2 o'clock, Jay Powell spoke. He spoke and he changed his tone a little bit from the FOMC. He actually said, look, I'm willing to raise interest rates if needed. He said those words and the market tanked. And it held support overnight. And then the news came out. The news came out for the news came out for the inflationary sentiment, right? So actually, the sentiment, the vote was in 1 year. People who did the survey actually thought the inflation was going to go up within the year. So the market pulled back, and that's what I thought. I thought the market was going to continue down, but it kept going up. So that means from the result of what happened Friday, the market is almost ignoring the data now. So CPI, if it comes in bullish, the market would rip even more. If it doesn't come up as strong as possible, it pulls back. But I think almost all the dips get bought. This here suggests to me that there's a huge support here. Hard for the market to break below this, probably by the end of the year.
If you want to learn more in depth and trade alongside us, you can always check out SuperLuckeee.com. Otherwise, keep following our Twitter. We post a lot of news. Learn a lot on why the market dynamics are trading the way it is, and always stay green. God bless you. Love you guys, and see you again. Bye.